Detroit this year saw a pickup in initial public offering activity here in the United States. The top offerings of the year: Samsonite International, the luggage maker, that was back in February, followed by Dollar General, the retailer, as well as Zynga, the games maker. Now, we also saw the highly anticipated initial public offerings of Groupon and LinkedIn, social media. Next year's big offering, no doubt, Facebook. But what else can we expect from the initial public offering market? With me now, joining us from Chicago, is Josef Schuster. He is the founder of IPOX research firm IPOX Schuster. Good to have you with us, Josef Schuster. Tell us about the initial public offering market. I mean, when you look at where the money has gone, could you consider it healthy and robust this year?
It actually has been a pretty good year in terms of IPO performance. It obviously depends how you measure it, but if you measure it over a 4-year horizon, actually, the IPOX strategies are actually up on the year. You're outperforming substantially again. The third year in a row, and the returns are driven by companies, which went public like in 09, 08, like a Visa, like a Philip Morris, like a L'Oreal, like a Mead Johnson. And obviously on the short end, you had underperforming companies such as GM and so forth. But overall, it has been a pretty decent year for the US IPO market, and in particular, kind of deal flow the deal flow is really concentrated amongst companies which are domiciled in the US. Investors here in the US do not want any foreign IPOs anymore. It's really the typical, traditional, good old US IPO, which has been doing pretty well, actually.
Josef, the focus for you, if you can, on technology initial public offerings. Many times we think of the IPO market as dominated by technology. What was the mix of technology IPOs?
Well, I mean, there were a large number of technology IPOs this year. Obviously, social media was the highlight. What we realize in many of these technology IPOs, those seem to have been priced really at the top of their potential market cap right out of the get-go, and then you get a lot of volatility down the road. We see Pandora down substantially, Yandex down substantially, LinkedIn, we saw Zynga down, Groupon down, and so forth. So there's been a good mix of specialty technology, but from an investment perspective, the returns really have come more or less from the boring companies like a GNC Nutrition, such as a LPL, such as Nielsen Holding, for example.
Well, what is this bode for technology initial public offerings in 2012? I mean, has what has happened to those IPOs tarnished investor appetite for more tech?
I believe it's not tarnishing substantially. I think there's still a lot of pent-up demand for the U.S. domicile deal, especially for big brands, Michael Kors type of deals. It may definitely affect the valuation of Facebook coming up for sure, because you have this big volatility in these tech IPOs where you are just not compensated for participating anymore.
Josef, what about the trend in initial public offerings of not really releasing many shares for trading, and as a result, that really changes the nature of the price?
Yeah, it's obviously, we believe investors and long-run investors especially should stay away from this type of IPOs, like especially Groupon type of IPO, where the investment banks use the float in order to maximize initial market cap, and then it's down the hill from the initial IPO price. So by investing in IPOs, it's very important to look at the float, the percentage of equity offered. The higher it is, the relatively better it is, the more fair is the market and the price for the long-run buy and hold investor.
Josef Schuster, what about innovative ways to bring companies to the public market? For example, Google came public as a Dutch auction. Is there any possibility we'll see a revival of new and innovative ways to go public?
I do not believe that anything will change next year in terms of how companies will be coming to the market. Obviously, it seems that Facebook is pretty much set on a very conventional type of offering procedure. Not really surprising, because of some of the initial IPO investors now pre-IPO are Goldman Sachs and some of the major investment banks. So nothing new in that type of front, unfortunately.
Josef, what about the popularity of investing in companies before their initial public offering, buying those shares in private markets?
That has increased definitely, especially year to date and last year. we believe we are really, post-IPO investors. We believe a lot of this initial, there's a pre-IPO market are really one-sided. There's only buy-only interest. And I think investors in general, especially the retail population, should be very careful in investing in it. As recently as Singer shows, there were large funds buying Singer at a premium of 30 to 40%. Before it actually, compared to where it actually is trading today. So it's not really like a one-way street with pre-IPO prices, and especially for the larger deals, there can be substantial downside risk once the respective company is actually trading in the public markets because of, obviously, plenty of liquidity available.
I want to thank you very much, Josef Schuster, joining us from IPOX Schuster, joining us from Chicago. Thank you.